You're hearing it everywhere. Rates are too high. Deals don't work anymore. Real estate is dead. Do you really think that is true? Do you think the largest real estate companies in America are going bankrupt because of high rates? Do you think Blackstone, Welltower, Brookfield, Hines, which collectively hold more than $1 trillion in assets, are laying off people because there are no deals in the market? Is that true? In fact, BlackRock is making so much money that a report in Financial Times is calling this market confident, merry, sparkling, optimist, and that the environment feels like as if it has hit escape velocity and now there is no turning back. Let me tell you something right now. If your rentals don't cash flow right now, it's not because of the interest rates. It's because of how you're buying them. And today, I'm going to break down exactly how smart investors are still making properties cash flow at 7+% rate. And that also in places like Charlotte, where deals are happening every day. This is not theory. This is actually how deals are getting done right now. And if you stay till the end, I'll show you through a real cash flow breakdown, so you can see how this actually works with real numbers. Let's get into it. Hi. My name is Vikram Chopra. I'm an investment banker and a broker in the greater Charlotte metropolitan area. I invest in this market and I help others also invest in this market and help them get to their financial freedom. I'm going to walk you through a real cash flow breakdown so you can see how this works with actual numbers. Chapter 1. The big lie about interest rates. First, we need to kill a myth. High interest rates do not kill cash flow. Bad underwriting kills cash flows. Overpaying kills cash flows. Lazy deal sourcing kills cash flows. Let's look at some context now. When the rates were 3%, people could still overpay and survive. Now, there's no room for sloppy investing. Higher rates just force you to become sharper. Back in the early 2000s, the rates were 6 to 8%. In the 90s, even higher. In the 80s, double digit. And investors still made money. How? What changed? Prices exploded during the low rate era. When the rates went up, the prices did not come down. They didn't crash hard enough to compensate. That's why today the deals feel tight. And here's the truth. Most people don't want to admit. High interest rate markets are some of the best times to buy. Why? Less competition, more motivated sellers, more creative deals. The amateurs leave and the killers stay. When the rates are low, everyone buys. And when the rates are high, only the professionals buy, you and me. Let me show you this house that's currently active on Zillow. It's a 2-bedroom, 2-bath in South Boulevard, a few miles from uptown Charlotte. That area is vitalizing. It is a solid blue-collar tenant hub. I myself own 2 properties in the same complex. This home is listed for $135,000. I'm sure when you do a walkthrough of the house, you'll find some stuff that is old and needs replacement. You can use that old stuff as leverage and negotiate a lower price. It's not very difficult to buy this house for $120,000. From the pictures, it doesn't look like it needs major renovations. The kitchen looks old but doesn't need immediate replacement. The bathrooms look recently updated, and Zillow estimates that it'll rent for $1,350 a month. I use the mortgage calculator to find my monthly cost, which also includes a monthly HOA fee of $200. As you can see from the math, the total monthly expense is $1,149. Assuming that you can rent this place for $1,350, you're looking for a cash flow about $200 every month. Who said you can't buy a cash flowing property, investment property, when the interest rates are that high? I just showed you with this property that is active and listed right now in Charlotte that you can make at least $200 of cash flow, a positive cash flow every month. I know it's not a lot of money, but for people who are entering into the real estate investment business, when the rates are this high, it's a great starter investment home. It's small in size in the middle of a major growing metropolitan area. Low down payment, perfect for getting to know the business model and the market. What else does an investor need? Chapter 2, Buying Below the Market. This is non-negotiable. In a high-rate environment, appreciation slows. If you are paying retail in a high-rate environment, you are losing, my friend. You must, absolutely must, buy below the true value. Not Zillow value, not what the listing agent says, not what your buddy paid in 2021. Below intrinsic value, so that the cash flow is baked in from day one. You cannot buy retail price anymore. You need price reductions, distressed sellers, off-market properties, tired landlords, probation situations, divorced sellers, outdated properties. Look for those type of properties. In markets around Charlotte, I'm seeing properties that are sitting longer. Investors are overpaying just to get in. Wrong move. And on top of that, the days on the market are higher than those frenzy years. That's where the opportunity is. If the market value is $300,000, you need to be at $250,000 to $270,000 max. That discount is what absorbs your high interest rate. In high rate environments, your profit is made on purchase, not appreciation. If you are shopping on Zillow and are offering asking price, you're not investing, my friend. You're just gambling. If you cannot negotiate at least 10 to 15% below the asking price, there is no need to invest. Just walk away from the property. There are many more properties that will come along the way. Visit your local courthouse. You don't have to buy anything at the moment. But it is important to visit the court and see how properties are being auctioned every day. Every courthouse publishes a list of properties that it will be auctioning during the next scheduled docket. I can almost bet $100 of all the people that are watching this video, less than 5% of you have visited the local courthouse to check out properties that are being auctioned or know someone who has been to these auctions. Less than 5%. That's a really small number. Tell me in the comments below if you have visited your local courthouse and seen how a property has been auctioned. And those who are buying are becoming millionaires even in this environment of high rates. But hey, if you are an elite investor, you know how to sniff out cheap investment properties and make your millions real quick. I've been to the courthouse many times over. I'll tell you my thought process, why I go, what I observe, how I take notes, and how I play this entire game in my head even before stepping foot in the courthouse. Boss, real estate investing is the all-consuming thing in my life. And frankly, it's extremely rewarding too. So I get a list of all the properties that are being processed by the court. Very simple. I go to auction.com. Look, here's what it is in the court system currently. Just in McLemore County in Charlotte, North Carolina. Next, I narrow down on the properties that I think I can buy. I'm not just buying anything at the moment. I'm playing this mental game where I'm learning the process and learning how to deal also. I make a small list and properties that are not more than $150,000. I don't care about the $1 million or the $2 million or the $5 million properties that show up in the courthouse. Too high of a risk for me. Next, on the bidding day, I go to the courthouse with my notebook. The bidding starts, people bid, I don't. I just sit there. I'm in the learning phase. Eventually, someone throws a bid number big enough that the auctioneer stops the bidding and loudly says, sold. Hit the hammer 3 times. I note down in my notebook how much the property was sold for. I leave the courthouse and I visit the property. I look at the neighborhood and I look at the condition of the house from the outside and take notes. And then I wait. If the property does not show up in the rebidding section, that means it has been sold. In a couple of weeks, the property is taken off Zillow also. And the sale price is displayed. It should be the same number that I should see in my notebook. And more importantly, it should be at least 20% less than the market price of a similar property in that neighborhood. You can then refinance it, flip it, do a million things to the property. It all depends on your strategy, but you did make money because you bought the property at a discounted price, even when the rates are so high. See, this is how you buy a property below the market price. Chapter 2, strategy. Terms over price. This is called creative financing. This is where the deals get really exciting. Right now, millions of homeowners have 2 to 4% interest rate on their mortgage. That is gold, but the problem is they can't sell their home easily because if they do, they have to buy another one and it's no longer 2 to 4% interest rate. They'll have to pay way higher interest rate for the new home that they intend to buy. So what do? You don't ask for a price cut. You ask for terms when you want to buy that property from them. Option 1, subject to. You agree to buy the property from the seller. You take the title at closing. The original loan stays in the seller's name. You take over their existing low interest mortgage payments. You keep their 3% interest rate. You control the property. Your monthly payment stays low. That's total control. Your payment stays low. That's instant cash flow. And the benefits are exceptional. You beat the high interest rate and keep it low. by using the seller's low interest rate. You don't need to qualify for a new mortgage, and so no bank qualifications needed. And on top of that, low cash out of pocket, no more than 20% from out of pocket. And why do you think the seller is going to agree to these terms of yours? Oh, they will. Sellers who are behind on payments and are facing foreclosure, relocating quickly, have little equity, and need debt relief more than cash will 100% definitely listen to my smart investor friends. That's you. Option 2, seller financing. Instead of a bank at 7.5%, you negotiate with the seller at 3%, 30 to 40 years of amortization, and interest only for 3 to 5 years. You would be shocked how many tired landlords say yes when they care more about steady income than lump sum cash. This works best for sellers who own the property free and clear, want passive income and want to defer capital gains, are having trouble selling traditionally and want a higher sale price. And once the interest rates come down in the future, you can refinance it and own the property. There are so many creative ways around this. Option 3, rate buy downs. Rate buy down equal to paying some money upfront so that you can get a lower interest rate, either temporary or permanent. If you're using conventional financing, negotiate a seller credit to buy down your rate permanently. When interest rates are high, sellers offers buy downs instead of lowering the sale price. Buyers qualify with low earlier payments. A 1% rate down can mean hundreds of dollars, additional dollars in the monthly cash flow. In today's markets, terms matter more than price. Let me repeat that. Terms matter more than price. Chapter 3, increase income. This is where most investors are lazy. You cannot control the interest rate, but you can absolutely control the revenue. Ways to increase rent. Add a washer and dryer rental. Pet rent, $25 to $50 per pet. Storage rental. Midterm rental hikes. Section 8 vouchers, rent by the room. I don't know how many people charge a pet rent, but I always do that. Most tenants at first say, oh, this is my service dog. You can't charge me a rent for this dog, which is fine. But then I want to see the certificate. If no certificate, there is a pet rent. No exceptions, no BS. I own a few condos in Alexandria, Virginia. Some of my condos have a garage parking. I rent my parking spot to others, not the tenant living in my condo. The tenant cribs that he has to remove the snow from the car every winter, but I don't care. Well, sorry, boss. I rented you the house, not the parking spot. I need that extra cash. In fact, when I don't see the rent come in by 12 midnight on the 5th of the month, I get so excited. Now I'm getting a late fee too, and I absolutely need that late fee. No waivers to anyone. And almost every time, I'm secretly wishing that the guy is late in paying his rent. The late fee is always 5% of the rent. For simple math, let's just say that the late fee is $100 for each home. Now, if you have 20 homes, then the late fee is $2,000 every month. Can you really give up $2,000? No, I cannot. I'm running a business here. I'm not running an NGO, a non-profit NGO. Who says you can't make money when the interest rates are high? I certainly do, and I will continue to do so. In certain corridors around Charlotte, adding $300 to $500 of rent every month is no big deal, with minor adjustments. That wipes out the pain of high interest rates. Here's an example. Mortgage, $2,000 every month. Rent, $2,200 every month. Cash flow, $200. Tight deal, right? Now we add $300 value through smarter strategy. Now the rent is $2,500. The cash flow is $500. That is real cash flow. Same property, different mindset. And wait till the interest rates go down. Your home is going to appreciate so much. You'll hike up the rent mid-lease because you can't wait to smell that cash flow. Chapter 4. House hacking. If the rates are high and you're starting out, stop. Stop trying to buy pure investment first. Buy a duplex, buy a triplex, or buy a fourplex. I truly believe in the power of a fourplex. Since this is the first home you're buying, you pay the lower first-time home buyer interest rate, which is at least 2 basis points lower than those provided to the investors. Live in one unit, let the remaining 3 tenants cover most of the mortgage. Use owner-occupied financing. Lower down payment, better rates, lower risk. Live in that house for 2 years and then buy another fourplex. Then move into one of the apartments in the new fourplex. The interest rate on the other second fourplex will also be lower. Voila! You have 8 homes in 2 years. You're living in one of those homes and you're renting out the other 7. Seriously, missing out on this hack is the biggest regret in my real estate investment life. When I was a student at the university, I was living in one of these apartments that were part of a fourplex. I was so focused on things that guys like me do in the university other than studies that I completely lost out on the best investment strategy in the world. And you know what? Buying 8 homes is not even the best part of this business model. The best part happens after 10 to 12 years when those 2 fourplexes double in value due to appreciation. If I knew about this and I had done it, I would have become a millionaire by the age of 25. But that's okay. This is life, and I absolutely love a challenge. This is how people build portfolios fast without bleeding out cash. You sacrifice for 1 to 2 years and you build a foundation for the next 20 years. Chapter 5, Value Add Always Pays. If you buy stabilized retail properties in high-rate environments, you're squeezing pennies. Instead, force appreciation in your apartments. Look for outdated kitchens, bad management, under-rented units, cosmetic rehabs, and you can raise the rent by $200 to $400. Now refinance later when the rates drop. Here's another thing I've noticed in apartment buildings. There's only one water meter for the entire building. That means the owner is paying the water bill from his own pocket. Guess what? No smart investors like you and me like it. With these high interest rates, I want to find a way to cut my expenses and improve cash flow. Here, look at this image. I found it on the internet. The owner of this building has installed water meters for all the apartments in the building. He just passed on the water bill to the tenant. Amazing, isn't it? He doesn't have to pay the water bill from his pocket anymore. The tenants will be more careful with wasting water. Here's an image of a duplex that I once owned in Chicago. The water meters were not separate and I was paying for the water bill every month from my own pocket. In this old image, the blue and white thing is a standalone above ground pool that filled up every day and drained out every day. Can you imagine what happened to my heart when I saw this with my own eyes? It was like a dagger going straight into my belly. It was such an abuse of water because the tenants were not paying for it. I was, so they didn't care a damn about it. No one told me of all these hacks when I was building my business. There was no mentorship. There was no guidance. I lost so much time. I lost so much money, so many years. But as I said earlier, I am a warrior. I don't give in, I don't give up. Anyways, that's a BRRRR strategy in a high interest rate world. The refinance is your second win. Chapter 6, Adjust Your Expectations. Here is where people get emotional. In 2021, $500 of cash flow every month was common. Today, maybe it's $250, maybe, and that's okay. I just showed you that apartment in South Boulevard. In Charlotte, that was providing you $200 of cash flow every month. Cash flow keeps you alive. Equity builds wealth. If the area is strong, populations is growing, jobs are growing, a slightly thinner margin today can explode in 5 years. Investing is long term, not Instagram. Let time do its thing. Month over month over month, the tenant is paying off your home. It's like eating an elephant. How do you eat an elephant? You eat it by biting the damn thing one bite at a time. Real estate investing is a long haul game. Donald Trump's dad used to buy foreclosed homes in Bronx and Queens in New York City. That's how he became the rich and famous guy that we know of today. Of course, his son, Mr. President, today has grown his business over the years. See, even you can do that. Once you have 20 plus properties in your portfolio, you will have enough cash coming in that you'll start buying homes like parents buying candies during Halloween. You have to be patient though. You need time and tenants to do their thing. Time will appreciate your properties and the tenants will pay off your loan. The tiny cash flow of $200 will jump to $20,000 in 15 years every month. You'll see it for yourself. Chapter 7, the real number breakdown. Let's break down a deal just so that we can understand it better. Purchase price $280,000. Down payment 20%. Loan $224,000. Interest rate 7.25%. Monthly payment about $1,950. Rent $2,400. Cash flow before expenses about $450. Subtract vacancy 5%, management 8%, maintenance 8%. You might land around about $150 to $200 every month net. Not insane, but solid. Now imagine you buy $20,000 cheaper or negotiate a 7.5% seller interest rate, seller financing, or increase the rent by $250. Now that $150 becomes $400 to $500 of positive cash flow every month. That's how pros think. Layered strategies. The mindset shift. High rates are not the enemy. In fact, the best investors that I know are buying more right now. Why? Because most people are scared and fear creates opportunities. 5 years from now, people would say, oh, I wish I bought when the rates were high and the compensation was low. Don't be that person who waits for the perfect conditions. There are no perfect conditions, only disciplined investors. Now, if you're investing in Charlotte or anywhere in the Carolinas and you want me to break down your deal, drop the purchase price, expected rent, down payment, and strategy. I'll show you exactly how to structure it for cash flow. If this video helped you think differently about high interest rates, hit the subscribe button. Give me a thumbs up because the market rewards the educated and punishes the emotional. See you in the next one. That's it from my side. This is Vikram signing off. Good luck, goodbye, and go earn your freedom even when the interest rates are high.